Okay, so you've sent us this dense package on Morgan Stanley's latest earnings. We've got the official report, analyst takes, the whole 9 yards.
Yeah, quite a bit there.
And the goal really is for listeners who want the essential insights, what's really driving things, but without getting totally bogged down in all the financial jargon.
Exactly. Consider this the express lane.
Right. So this is our deep dive into Morgan Stanley's first quarter 2025 results.
And we're drawing from, well, everything you mentioned, their official release, the earnings call summaries, various news analyses.
The good mix.
Yep.
Official data, expert views.
Yeah, to get that rounded picture.
So our mission here is to pull out the biggest takeaways. How did they perform? What are the key trends in their different divisions? And maybe what does it hint about the wider economy?
Sounds good. Let's get into it.
Okay, let's start with the big picture then.
Yeah.
The overall financials for Q1 2025. How do they look?
Well, they looked really strong. Actually, record net revenues. They hit $17.7 billion for the quarter.
Record revenues. Okay, how does that compare?
Well, compared to the same time last year, Q1 2024, that's up 17%. They did $15.1 billion.
17%, wow.
And it's also up nicely from the previous quarter, Q4 2024. That was $16.223 billion, so this is about a 9% increase from that.
Okay, so strong growth both year over year and quarter over quarter. How did that translate down to the bottom line? Earnings per share.
That followed suit. Diluted EPS, earnings per share, came in at $2.60.
$2.60. And how does that stack up?
Again, really solid growth. It's up 29% from the $2.02 they reported in Q1 last year.
29%.
Yeah. And it's also a good jump, 17% from the $2.22 they did in Q4.
And did this meet what analysts were expecting or beat it?
It actually beat expectations quite handily. Visible Alpha, for instance, they were estimating around $2.18.
Oh.
And Motley Fool's consensus number was about $2.21. So, $2.60 is significantly ahead of both.
Right. So not just good results, but better than expected results. That always gets attention.
Right.
What about efficiency metrics like return on equity?
Yeah. The key one there is ROTCE, return on average tangible common equity. Think of it as how well they're using shareholder money to make profits.
Right. Higher is better.
Exactly. And they reported 23.0% for Q1.
And how does that compare?
It's a nice improvement. It was 19.7% in Q1 2024 and 20.2% just last quarter, Q4. So definitely moving in the right direction.
Okay. And the overall net income figure?
Net income applicable to Morgan Stanley was $4.3 billion.
$4.3 billion.
Which is up 26.5% from the $3.4 billion they earned a year ago.
Okay, these are consistently strong numbers. I imagine the CEO, Ted Pick, was pretty pleased.
He was, yeah. The commentary highlighted a very strong quarter, mentioned the record net revenues, of course, and he specifically pointed to, quote, consistent execution of our clear strategy to drive durable growth.
Consistent execution. Okay, so emphasizing the strategy is paying off.
Seems to be the message, yes.
All right, so the overall picture is definitely bright. Let's dig into the segments now. Institutional Securities is usually a big part of the story.
Yeah.
How did that division do, especially with markets being a bit choppy?
Institutional Securities had a phenomenal quarter, really drove a lot of this performance. They also hit record net revenues, $9.0 billion. Well, $8.983 billion to be precise.
$9 billion, that's huge. How much of an increase is that?
It's a massive jump, up 28% compared to the $7 billion or so they did in Q1 last year.
28%, okay.
And it's also up 24% from the $7.267 billion in Q4. So, yeah, they really capitalized on something there.
So what was that something? What were the main engines for that growth within Institutional Securities?
Well, the star was really equities trading. Equity revenues hit a record $4.1 billion.
$4.1 billion, just from equities.
Just from equities. And that's, get this, a 45% increase from the $2.8 billion last year.
45%? Wow. What's driving that kind of surge?
The reports point to a few things. Increases across different business lines, different regions. Asia was mentioned as particularly strong.
Yeah.
And specifically, they called out prime brokerage and derivatives. Said it was driven by strong client activity, with the more volatile trading environment.
Right. So volatility helped them here. Hedge funds, big investors getting active.
Seems like it. Plus, they mentioned portfolio rebalancing by investors, especially in tech and industrial stocks. Seems their platform and client relationships, maybe particularly in Asia, were well positioned.
Interesting. So the choppy markets were actually a tailwind for their equities desk. What about fixed income? Also sensitive to markets.
Fixed income also did well. Revenues there were $2.604 billion.
Okay.
That's up 5% from Q1 last year, but interestingly, it's up a huge 66% from Q4 of last year.
66% quarter over quarter. That's a big rebound.
Yeah, suggests Q4 might have been weaker or Q1 was just particularly strong in that area.
Right. And the traditional investment banking side, M&A advice, underwriting deals.
Investment banking overall saw revenues up 8% year over year, reaching $1.559 billion.
Okay, 8%. How does that break down?
It's a bit of a mixed picture inside that number.
Right.
Advisory revenues, so M&A work, were up because more deals actually closed.
Makes sense.
Fixed income underwriting was also up. They cited more activity in non-investment grade loans, so maybe higher yield stuff.
Okay, risk on there.
Potentially. But on the other hand, equity underwriting revenues actually decreased compared to last year.
Huh. So M&A and debt underwriting up, equity underwriting down, different parts moving differently.
Exactly. Shows how varied that business can be.
Anything else notable in institutional securities? Sometimes there's another category.
Yeah, and other revenues were actually up quite a bit. They said it was mainly due to gains on selling corporate loans they held for sale,
Oh, okay.
which is better than the mark-to-market losses they had on similar things a year ago. So a swing factor there.
Got it. And the bottom line for this division, pre-tax income.
Pre-tax income for institutional securities was strong at $3.3 billion, up significantly from $2.4 billion last year. Really reflects that top-line revenue surge.
Okay. Clearly a powerhouse quarter for institutional securities. Let's pivot now to wealth management. That's such a key focus for Morgan Stanley's strategy. How did they fare?
Wealth management turned in another solid performance. Net revenues were $7.3 billion, $7.327 billion specifically.
And the growth rate there.
That's up 6% compared to the $6.88 billion in Q1 2024.
Okay, 6%. Steady growth.
Steady year-over-year growth. It was, however, down just slightly, about 2% from the $7.478 billion they did in Q4.
Okay, slight dip sequentially, but still growing annually. What were the key metrics within wealth management? Assets.
This was a real highlight. Net new assets were incredibly strong, $94 billion, $93.8 billion technically.
$94 billion in new assets in one quarter.
Yep. Almost matching the strong inflow from Q1 last year.
Yeah.
And way up, like 66% higher than the $56.5 billion they brought in during Q4.
That's huge. What's driving that inflow? Do we know?
The sources don't break down exactly why clients are bringing assets over, but that kind of number speaks volumes about client confidence, advisor performance, maybe their platform. Something's clearly resonating. It pushed their total client assets up to $7.7 trillion.
$7.7 trillion. Just staggering scale. Are these assets coming into fee-based accounts? That's usually the focus.
They are. Fee-based asset flows were very strong, about $30 billion, $29.8 billion reported, of that $94 billion total inflow.
Okay, so a good chunk going into those more stable revenue streams.
Exactly. And that helped lift their total fee-based client assets to almost $2.35 trillion, up from about $2.12 trillion a year ago. Asset management revenues within the division grew because of these higher asset levels.
Makes sense. More assets, especially fee-based, means more revenue. What about transactional activity? Were clients trading much within their wealth accounts?
Transactional revenues showed a pretty healthy 13% year-over-year increase, but that's if you exclude a specific accounting item.
Okay, what's the item?
It's the mark-to-market impact on investments linked to their deferred compensation plan, or DCP. It can swing around a bit.
Right. So if you strip that out to see underlying client activity.
It was up 13%, suggesting clients were more active, especially in equities. But if you look at the reported number, including the DCP impact, overall transactional revenues were actually down at $873 million compared to over $1 billion last year.
Interesting. Good to have that context on the DCP impact. What about net interest income from loans and deposits in wealth management?
That saw a small increase, $1.902 billion compared to $1.856 billion a year ago. Pretty stable there.
Okay. And profitability for wealth management. Pre-tax income and margin.
Pre-tax income was $2.0 billion. That resulted in a pre-tax margin of 26.6%.
26.6%? That sounds pretty healthy.
It is. It's a very solid margin. While the revenue growth wasn't as explosive as institutional securities, wealth management remains a very consistent, very profitable engine for them.
Yeah, you can see why it's such a strategic pillar. Okay, third main division, investment management. How did that part of the business perform?
Investment management reported net revenues of $1.6 billion, $1.602 billion.
Okay, and the growth.
That's up 16% from the $1.377 billion in Q1 last year. So Good year-over-year growth again.
A similar pattern to wealth management sequentially.
Exactly. It was down slightly, about 2% from the $1.643 billion in Q4.
Okay. And their assets under management, AUM?
AUM reached $1.7 trillion, $1.647 trillion reported. That's up nicely from $1.5 trillion a year ago. So the overall asset base is growing well.
Right. But what about flows? Were they attracting net new money into their funds?
It's a bit of a mixed story on flows. Long-term net flows were positive at $5.4 billion.
Positive is good. How does that compare?
Well, it's down from the $7.6 billion they got in Q1 last year, so down 29% year over year.
Okay.
But it is up from the $4.3 billion in Q4, so a 26% sequential increase.
So improving from last quarter, but not as strong as a year ago. Can we see where the money went by asset class?
Yeah, the breakdown is interesting. Equities actually saw net outflows of $4.7 billion.
Outflows from equities, even while the trading desk was booming.
Yeah, it's an interesting contrast, isn't it? Maybe different client types or strategies. Fixed income saw positive flows, $3.0 billion in.
Okay.
Alternatives and solutions were the winners, pulling in $7.1 billion in net flows.
Strong demand for alternatives.
Definitely seems that way.
Huh.
But then liquidity and overlay services, so maybe cash-like products, saw significant negative flows, outflows of $19.0 billion.
Wow, big shift out of liquidity products there. So
Yeah.
really a mixed bag on flows within investment management.
Very much so. Strength in alternatives, inflows to fixed income, but outflows from equities and liquidity.
How did that impact the division's profitability then, with those mixed flows?
Despite the mixed flows, pre-tax income was actually up. It came in at $323 million compared to $241 million a year ago.
So they managed profitability well, even with those flow dynamics.
Seems so. Suggests maybe fee structures or expense control helped offset the weaker flow areas.
Okay, that covers the three main business lines. Let's talk costs now. Running a giant like Morgan Stanley isn't cheap. How did expenses look?
Expenses were definitely up. Firm-wide compensation costs were $7.521 billion. That's up from about $6.7 billion in Q1 2024.
Okay, higher comp costs. What about non-compensation expenses?
Those were up too, $4.539 billion compared to about $4.05 billion a year ago. So costs rising on both fronts.
Any specific reasons called out for the increase? Anything unusual?
Yes, there was one specific item mentioned. Severance costs. They took a charge of $144 million in Q1.
Severance. Was there a layoff?
Yeah, they mentioned a reduction in force, a RIF, that happened in March, affected about 2% of their global workforce.
2% across the board.
Pretty much. Impacted all the segments. Institutional Securities took the biggest chunk, $78 million, Wealth Management, $50 million, and Investment Management, $16 million.
And the reason given?
They attributed it to performance management and aligning the workforce with business needs.
Okay, so despite those severance costs, did their overall headcount go down?
Interestingly, no. Their worldwide employee count actually edged up slightly. It was 81,023 at the end of Q1 compared to 79,610 a year earlier.
Huh. So they cut in some areas, but are still hiring or growing elsewhere. A strategic shift, maybe?
That's what it suggests, yeah. More of a realignment than just broad cost cutting.
Right. Now, super important for any bank. Capital strength. How solid is Morgan Stanley's foundation?
Very solid. Their capital ratios look strong. The Common Equity Tier 1, or CET1 ratio, which is a key buffer against losses, stood at 15.3% under the standardized approach and 15.7% under the advanced approach. Both of those are actually improved from a year ago.
Oh, improved ratios. That's good.
Yeah, same story for the Tier 1 capital ratio, 17.2% standardized, 17.7% advanced, also showing year-over-year growth.
And the balance sheet itself. Assets, loans, deposits.
All growing. Total assets hit $1.3 trillion, up from about $1.23 trillion last year. Loans increased to $259 billion from $227 billion, and deposits reached $381.6 billion, up from $352.5 billion.
Okay, so a strong, growing, and well-capitalized balance sheet provides a lot of stability.
Definitely. Gives them a good cushion.
Let's quickly touch on geography. We heard Asia was strong in institutional securities. How did the regions perform overall?
Yeah, good question. The Americas still the giant, of course. Revenues there were $13.1 billion, up a solid 13% year over year.
Okay.
But the growth rates elsewhere were even more impressive. EMEA, that's Europe, Middle East, Africa, saw revenues jump 25% year over year to almost $2.3 billion.
25% in EMA.
Nice. And Asia, as we noted, was even stronger. Revenues there were up 35% year over year, hitting $2.345 billion.
35% in Asia. That's really standout growth, driven mostly by that trading activity we talked about.
That seems to be the main driver mentioned, yes.
Yeah.
Strong client activity, the prime brokerage and derivatives performance within institutional securities really boosting that region, highlights their global reach.
Definitely shows the strength isn't just U.S.-based. Okay, finally, the outlook. Did Morgan Stanley give any guidance for the rest of 2025? And what are analysts thinking?
They were cautious on formal guidance, didn't offer specific forward-looking numbers in the release.
Why not?
They cited the broader economic uncertainty out there, standard practice for many companies when things feel a bit unpredictable.
Makes sense. But did they signal any strategic priorities?
They did emphasize they plan to use their strong capital position strategically and continue investing in technology across the firm.
Okay, focus on capital in tech. What about the analysts? If the company isn't guiding, what are the expectations on the street?
Well, despite the lack of official guidance, the analyst consensus seems generally positive on the stock.
Really? How positive?
Looking at, I think it was 16 experts, the average price target is around $132.56.
Okay, and where's the stock trading now?
Around $107.91 when these reports came out. So that target implies, what, about a 23% potential upside.
Significant potential upside then, according to analysts.
Yeah, and another source, guru-focused GF Value, also suggested potential upside. But, standard disclaimer, these are just forecasts, lots can happen.
Of course, always take targets with a grain of salt. But it suggests the market liked these results.
Okay, let's try and boil this all down. What are the absolute key takeaways from this Q1 deep dive?
Right. Well, first, it was clearly a standout quarter financially. Record revenues.
Driven heavily by
That massive performance in institutional securities, especially equities trading, which surged 35%. They really capitalized on market activity.
Okay. Takeaway number one, trading boom. What else?
Second, wealth management continues to be a powerful, steady engine. That huge $94 billion inflow of net new assets is a major sign of client confidence and growth momentum there.
Got it. Strong wealth management growth. Third,
the firm's financial foundation looks really solid. Those improved capital ratios, growing deposits provide a strong base.
solid capital. Fourth, investment management performance was okay overall, but the flows were really mixed. Strong interest in alternatives, but outflows elsewhere, particularly liquidity. Something to watch.
Mixed flows in investment management. Anything else major?
Maybe the expense side. Costs are up, and there was that strategic workforce adjustment, the RIF, even as overall headcount grew slightly, shows they're actively managing resources.
Strategic cost management.
And geographically.
Yeah. Strong growth, not just in the Americas, but especially impressive jumps in EMEA and Asia, highlighting global strength.
Okay, so record revenues via trading, strong wealth growth, solid capital, mixed flows in IM, strategic workforce shifts, and broad geographic strength.
That about sums it up. And despite being cautious on guidance due to the economy, analysts seem to see potential.
Right. So we've really tried to hit the goal here. Provide that clear, comprehensive understanding from all the sources, give you those key insights without drowning in the details. Hopefully that hits the mark. And, thinking ahead, Morgan Stanley's talking a lot about tech investment, and we just saw how much market volatility helped their trading desks. It makes you wonder, doesn't it? What long-term strategies are really going to be crucial for them to keep growing sustainably in this landscape that just keeps changing?
Yeah, that's a great question. Is the trading surge sustainable? How much can tech really move the needle long term?
And how will those bigger global economic factors, inflation, interest rates, geopolitics, how will they keep shaping these different business lines? Where are the next big opportunities or, the potential headwinds?
Definitely things to keep mulling over. Good food for thought. Well, thank you for sharing all these detailed sources with us and for trusting the deep dive to unpack it all. We really hope this gave you the clarity you're looking for.
Hope so too.
And we look forward to our next exploration together.